Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. A considerable amount of market uncertainty has dissipated in recent weeks, and disinflation has unfolded at a faster pace than many expected. At the same time, economic growth has also exceeded expectations. Joining me to discuss the backdrop, we have Sandip Bhagat. He is with Whittier Trust. It is great to have you with us, Sandip. Welcome to Trade Talks.
It's a pleasure to be here.
All right. And as Chief Investment Officer, we look forward to getting your thoughts here. Despite some big early gains, will the last mile of disinflation prove difficult to navigate?
So look, we have seen significant disinflation in recent months. I might even suggest that the speed of disinflationary descent has exceeded many people's expectations. And most remarkably, we have seen disinflation without any disruption to the labor market, which brings us to this juncture and fork in the road, which is, look, should we celebrate this as a very successful milestone on the journey to a soft landing, or are we going to fret and wring our hands that it's still too high, inflation is still above 2%, and this very economic strength is going to stoke inflation and cause rates to go higher and eventually precipitate a deeper recession? You need an answer? I'm in the former camp. This is good. We have less uncertainty and clarity on two fronts. Inflation is below expectations, and growth is firmer than expected. This should bode well for the stock market in the near term.
Well, with higher interest rates eventually slow down, will the consumer and this cut into corporate profit margins if we stay higher for longer?
Well, so we first need to debate how high rates will remain. And I'm more optimistic than the worst skeptics out there. I've heard talk about long-term interest rates reaching 5%, perhaps going even higher. I know we have a debt to GDP problem. We have a high debt burden, and people worry about the crowding effect from that. But we have a lot of positives from secular disinflationary effects from technology. That should keep rates low. There's a glut of global savings. There are a lot of natural buyers who need long duration assets. So I'm actually optimistic that rates don't go up that high. And with all the stimulus that has been provided from the government spending and low interest rates so far, we should see GDP growth that helps on the debt front. So to answer your question, high rates should not be a material problem. And very curiously, Jill, for the consumer, a much smaller percentage of their debt now fluctuates and is variable in nature. It's declined from 30% all the way down to 10%. So don't see this as a big problem.
Well, let's go back to the government's balance sheet for a moment here. How significant are the U.S. fiscal challenges, and do you think that could contribute to higher interest rates for longer as a result?
Yeah, we touched on some of those issues in the last few remarks. Look, at over 100%, the public debt to GDP ratio is absolutely high. And by the way, I'm not a big fan of reckless and irresponsible government spending. So did we need the stimulus in the first place to fight the pandemic? Absolutely. Did we do a touch too much of it? Perhaps. But will it debilitate us going forward? Are we doomed to these higher interest rates and much lower than trend growth for a very long period of time? I really, again, don't feel so. This problem will get worse if nominal rates stay above nominal GDP growth. But I'm in the camp that long-term rates will plateau right about here at 4.25%, 4.5%. Nominal GDP will exceed those levels. And therefore, this problem will not get any worse, and certainly not beyond the fundamental attractiveness of the US economy.
So to wrap this all up here, do you see the US economy encountering a soft, hard, or no landing?
Well, no landing is a new lexicon. It suggests that forget an outright recession, forget even a short and shallow one, that growth will simply come down to trend. Here's how I peg the odds. Soft landing is a dramatic slowdown to right around zero, maybe a short and shallow recession. Hard landing is a deep, protracted recession. No landing means we come down to 1.5% GDP growth, go no lower. The odds of a no landing, in my opinion, are greater than the hard landing, but still the most likely outcome is the soft landing with growth right around zero, maybe a short and shallow recession in the worst case.
All right. Interesting perspective. We appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq.
Terrific.